Hey guys, Adam Burns here, bringing it to you today on commonly used real estate terms and acronyms. We use a lot of these in our various episodes, and sometimes we don't get the opportunity to explain them in depth. So we're going to take some time. This is the first part of a multi-part series where we're going to cover commonly used terms and acronyms used in real estate investing so you can talk like a real estate pro. First term we're going to cover today is net operating income, or NOI for short. This is a measure of a property's potential to be profitable. We calculate it by taking a rough estimate of the gross revenue, or the total amount of money that the property is bringing in, and subtracting out all the expenses, such as repairs, maintenance, taxes, insurance, HOA fees if it's a condo, etc. This actually tripped me up at first. NOI doesn't actually take into account your financing or your mortgage. So when you're subtracting out those expenses, remember, you're not subtracting out your mortgage payments. So why does NOI matter? Well, it's a good way for you to look as an investor at multiple different properties and compare them apples to apples and determine which one's going to be a better investment for you. It's also important when you want to calculate cap rate, which we're going to talk about in just a second. So the next term, as I said, is cap rate, or capitalization rate. Simply put, cap rate is the ratio between the amount of money that you purchased the property for and the NOI. It's calculated by actually taking the NOI, or net operating income, and dividing that by the purchase price of the property. So for example, if you were to buy a property for $300,000 and the NOI in the first year is $24,000, what you would do is you would take your $24,000 and divide it by the purchase price of $300,000 to yield 0.08, or an 8% capitalization rate, or for short, an 8 cap. So why does it matter? Cap rate is just another one of those ways of evaluating an income property. A lower cap rate might mean that the property is going to cash flow less. However, it means that it's in a more stable area and you might have renters for more of the time, i.e. less vacancy. But on the other hand, you might see a higher cap rate in a riskier investment. You might make more money, but there might also be more vacancy, more risk in the long term. Both have a place in your rental portfolio, but it's up to you to figure out what that property is supposed to achieve. Cap rate is a quick and easy metric that you can use when evaluating multiple income properties, so it's worth having in your tool belt. The next term that we're going to cover is cash flow. This is essentially the amount of money that you're going to pocket at the end of each year, after you subtract out all of your operating expenses, including your mortgage payments. Put simply, if you spend less money than you earn, your cash flow will be positive. But if you spend more money than you earn, your cash flows are going to be negative. So why does it matter? Consistent monthly cash flow and monthly income is one of the most appealing reasons why people invest in real estate. Ideally, an investment property should be cash flow positive, which means that the rents that you're collecting are greater than the monthly expenses. Thus, you're provided with a steady stream of passive income. So the next thing we're going to cover is cash on cash return. This is the annual pre-tax cash flow of the property as a ratio to the amount of cash that you invested in the property, expressed as a percentage. Cash on cash return measures the yearly return as a proportion of the amount of money that you put into the deal. While cash on cash return is really great for being able to tell you how much money you're going to be making at the end of the day, it doesn't take into account some of the other benefits of owning property, such as depreciation and other tax benefits, appreciation of the property and growth of its value, or loan paydown and being able to own the property free and clear someday. So this is important to keep in mind. While cash on cash return is a great metric for measuring exactly how much return you have on the actual cash invested in the deal, unlike cap rate or some of the other metrics, it doesn't take into account the return as an overall proportion of the total investment. Basically, it's just the cash flow from 1 year divided by the actual amount of the cash that you've invested. So why does it matter? Cash flow is just one way of analyzing an investment by focusing on the returns realized on the actual cash invested in the deal. It also helps you understand the effects of leverage on a deal by looking at how cash on cash return changes when adding leverage as part of the financing package. Finally, it can help you compare different options of different properties that might have different cash requirements and help you determine which one is right for your portfolio. I'm going to leave you today with what I think is the single most important calculation in real estate investing, and what I use for comparing property to property when I'm determining a suitable investment for myself. That term is IRR, or internalized rate of return, and it's a pretty heavy calculation, so make sure you're paying attention to this. An IRR calculation is a great way of measuring a property's long-term profitability and is most often used when comparing different deals to take into account how long your capital is actually going to be tied up in each deal. In other words, it takes into account the time value of money, which is important because if you're looking at one deal that's going to take 2 years and it has a certain return, and another deal that's only going to take 1 year but has a totally different return, how do you compare the two if you don't take into account how long your capital is going to be tied up in each deal? The downside of this calculation is that it's super complex and you actually can't do it by hand, so most investors employ an Excel model or something like that in order to make the calculation. So if you're just getting your start and you don't have a model already set up, drop us a line and we'd be happy to share ours with you. So why does it matter? IRR is the best way to understand exactly how profitable an investment is for you over the entire time that you plan on holding on to it. It's able to compare multiple investments with different time horizons and different cash flows so that you can compare them all under one metric. So for instance, if you're looking at 2 different investment options and they both are going to return the same amount of money and they both ask for the same amount of capital, but one is going to take twice as long, the IRR for that one that's going to take twice as long as the other is going to be much lower, thus indicating that that's a less lucrative investment because you can make the same amount of money in half the time with the other investment. Well, that's probably enough for now, but make sure that you check back here for more real estate tips, tricks, acronyms, and breakdowns. And if there's anything else you want to hear about or things that you want us to go into deeper detail on, drop me a comment and I'd be happy to weave it into a future episode. Thanks so much for watching. We'll see you again real soon. Hey guys, Adam Burns here, and I'm with my wife Shelby. Like all of you, as I always say, she has tons of real estate questions.
Yep.
And we just got done watching the rough edit of our first Talk Like a Real Estate Pro episode, and I think you've got some questions for us.
I do,
What do you
yeah.
have?
So first question, how do you estimate a property's revenue? That's something that you mentioned in the episode, is that it's important to estimate a property's revenue, but how do you do that?
Yeah, so the revenue that I was referring to at that point is the rental income. So
Okay.
having a good idea of the rental income that a property is able to produce is important for all the evaluations that we talked about. But you can either go by existing rents that it's receiving if the
Okay.
property already has tenants in place, or you can look at similar properties that are available on the market to determine what the market value of those units are, add all the values together to come up with a total monthly rental income. If you don't feel comfortable doing that on your own, working with a local real estate agent is another way to accurately get at the local market value for that property.
Okay, and how do you do it? Like, so you could use the existing rents, but how do you know that you're getting that kind of market value, that it's, you know, kind of in line with the market, right? Because some landlords might not increase the rent necessarily because they want to keep the tenants, and if you're taking it over, you probably want to make sure that you're getting a fair market value or rent. So how do you determine that, or what do you tend to do?
Yeah, again, do your research. So we look at local market trends, and we kind of, in the areas that we invest in, we have a pretty good idea of what so many bedrooms, so many bathrooms equates to in
Okay.
terms of rent. But if we're in a new market, we are going to multiple online resources to determine what other things are renting for in that market.
Okay, great. Thanks for answering that.
Yeah, no problem. What else do you have for me?
So you mentioned cap rate, and to my understanding, or just to make sure I'm clear, is cap rate the rate of return on my investment? So if the cap rate is 8%, I'll get 8% of my return per year?
It's not necessarily a rate of return on your investment. It's a rate of income on the property as you deduct the expenses of the property exclusive of the mortgage payment
Okay.
from the revenue that the property is generating and divide that by the property value. So yes, you are using it as a metric to understand kind of what the property is yielding, but it doesn't directly get at what your revenue or rate of return is necessarily.
Okay, which term correlates to my rate of return?
It depends on what return you're looking at. Are you looking at return over the entire investment? Are you looking at return over
year.
the cash that you invested in it? So it depends on if you're looking at just the cash, the entire deal with the leverage that you've taken from a bank, or are you looking at just this year? Are you looking at the entire time horizon that you've owned it? So the different things that I covered in the episode cover what you want to look at, essentially.
Gotcha. So which is the one that correlates per year? Like per year total investment, like my money and the bank, this is all that was invested in the property, annual rate of return.
So I think the best way to get at that value is to look at IRR, because IRR takes into account time value of the money, so you can look at it over any time horizon, and you can also you're also looking at directly how much money is being generated over the time that you're owning the property.
Okay, and then going back to cap rate, what is your average cap rate?
So
range?
Yeah, so we don't typically do anything that's less than an 8% cap rate.
Okay, and is there a max? I thought at one point you had said, yeah, I don't go below, like 5 is the absolute lowest, not worth it, and I try not to exceed 12% because it's too risky. Yeah,
so again, I was talking about in-place cap rates and how those relate to perceived risk.
Mm-hmm.
Those aren't the only things that affect cap rate. Like you could maybe find a deal where you're able to derive more value and you get a higher cap rate in a stable market. That can potentially happen. It's just less likely to happen because cap rates do generally relate to the viability of investment or the potential risk of an investment. They fluctuate based on risk. But I think I got off tangent.
So your average is 8, or you try to stick to lowest of 8. What's the highest you've ever done?
We don't go below 8, and the best cap rate that I've seen, I think we've gotten upwards of 14, 15% cap rates sometimes.
Okay, and why is that?
So
like why is it that you don't go below 8? Like how did you land on that number? Why that magic number?
Yeah, it's hard to make financing work below that number.
Okay.
And that's just, we found that there's a prevalence of deals above 8, and they're just a little bit harder to find. There's a plethora of deals below 8. People sell cap rates of 5 to 8 all the time. Mm-hmm. They're very prevalent in the market. But if you're taking a mortgage on, and the mortgage payment, or the mortgage interest rather, is 4.5%, 5%, it's going to be really hard to have your other expenses make up the rest of that and still be cash flow positive.
Okay, awesome. Thanks for explaining.
Yeah, no problem.